The market is now closed for the weekend, but as of the final bell on Friday, November 14th, 2025, Beyond Meat, trading under the Nasdaq ticker BYND, ended its session at 1.08 per share. This figure is what has everyone talking. It represents a significant, almost startling jump of 6.93% on the day. In the after-hours market, it held those gains and ticked up just a fraction more, sitting at 1.09. Now, the immediate expectation when you see a nearly 7% gain on a stock this beaten down is that some fantastic game-changing news must have been released. Perhaps a new, massive partnership was announced, or a major analyst issued a stunning upgrade, or maybe the company pre-announced positive earnings. The reality, however, is far more complex and, frankly, far more telling of this stock's true situation. There was no company-specific news. There was no press release. That 7% move, which saw the stock swing wildly from an open of 0.94 all the way to a high of 1.23 before settling back to 1.08, was not driven by fundamentals. It was driven by a market dynamic that has become the only story that matters for Beyond Meat. A brutal, expensive, and high-stakes war between short sellers and the few remaining long-term holders, all amplified by a recent massive debt restructuring that has completely altered the share structure. For years, the common ground for investors regarding Beyond Meat was that it was a growth story. You were investing in a paradigm shift, a move towards sustainable plant-based protein. The company captured the public's imagination, secured massive deals, and its IPO was one of the most successful of its time. The expectation was that high growth would continue, margins would eventually appear, and this company would dominate grocery aisles. But that expectation has met a devastating reality. The stock is down from a 52-week high of $7.69 and an all-time high of over $230. It is now a low-dollar stock, trading just pennies above its all-time low of 0.50. The current narrative is one of failure, a story of cash burn, operational missteps, and waning consumer interest in what many now see as a chemically processed food, not a health food. The challenge for anyone looking at this stock today is to ignore both the original hype and the current despair, and instead look at the mechanics of the stock itself. The company's future may be in doubt, but the stock's recent movement is almost purely mechanical, driven by one of the most extreme short positions on the entire market, which has just been scrambled by a recent meme stock surge and a debt deal. Let's be perfectly clear about what is happening here. Beyond Meat is arguably one of the most embattled stocks on the Nasdaq. Recent data shows its short interest is well over 37% of the public float. This is an astronomical figure. It means that for every 100 shares available to trade, more than 37 have been borrowed and sold short by investors betting the price will fall. The expectation from these short sellers, many of whom are large, sophisticated institutional funds, is simple. They see a company that has consistently failed to turn a profit. They see a balance sheet that is deteriorating with cash reserves dwindling rapidly. They see a business model that is fundamentally broken in the current macroeconomic climate, where consumers are trading down to cheaper private label brands and traditional, less expensive proteins, not up to premium plant-based alternatives. This thesis was powerfully confirmed by the company's recent third quarter 2025 financial results, reported just days ago on November 10th. The numbers were disastrous. Net revenues were $70.2 million, a decrease of 13.3% year over year. The company posted a staggering net loss of $110.7 million, or $1.44 per share, which was far wider than the net loss of $26.6 million a year ago. The main driver of this loss was a massive $77.4 million non-cash impairment charge. This impairment is a formal admission by the company that its long-lived assets, its factories and equipment, are not worth what they claimed. This news led analysts at firms like Mizuho and Barclays to slash their price targets down to just $1, maintaining their underperform and sell ratings. But this is where the story gets complicated, and it explains Friday's 7% jump. In late October, the stock went on an unhinged parabolic run, surging over 600% in just a few days from its 0.50 low to a high of 7.69. This was a classic retail-driven meme stock rally. It was fueled by discussions on Reddit and X.com pointing to the extremely high short interest, which at the time was being reported by some platforms as over 80%. This rally, however, was also driven by misinformation. A massive debt for equity swap was finalized in mid-October, where over $1 billion in 2027 convertible notes were exchanged for over 316 million new shares. This quintupled the outstanding share count from around 76 million to over 397 million. This event is crucial. Many retail investors looking at old data saw a short interest of 51 million shares against an old float of 76 million and calculated an 80% plus short interest. The reality was that the float had just expanded massively, meaning the actual short interest as a percentage of the new float was closer to 14% at that moment. The hedge funds that held the convertible bonds were likely shorting the stock as a hedge. When they received their new shares from the conversion, they were free to cover their short positions and sell the stock, which they did. This is why the rally from 7.69 collapsed just as quickly as it began, with firms like D.E. Shaw and Wolverine reported to have sold off their new stakes. So why is the short interest still a reported 37.64%? And why is the stock still so volatile? Because even after that dilution, the bearish sentiment is overwhelming. New shorts have piled in, and the cost to borrow the stock remains high, with Fintel reporting a recent borrow rate of 26.62%. This is an expensive fee to pay just to hold a bearish bet. This creates an incredibly tense situation. For the short thesis to work, the stock needs to keep falling to offset this cost. This brings us back to Friday's 7% jump. On no news, a 7% spike on a stock with a 26% borrow rate and 14 days to cover is no new optimism. It is almost certainly short covering. It's the frantic buying of traders who were short, perhaps from a higher price, and are being forced to close their positions due to the high cost or fear of another irrational retail-driven spike. This is not just theory, this is actionable data you can track yourself. Many retail investors feel they are fighting in the dark, but you are not. You can look up BYND short interest on platforms that track this data, or even check the official FINRA bi-monthly reports. Don't just look at the percentage of float. Look at the days to cover. Fintel reports this at 14.15 days. This metric tells you it would take over 2 weeks of average trading volume for all short sellers to cover their positions. A high number like that signals a crowded trade and high squeeze potential. You should also monitor the borrow cost. If you see that 26% rate spike, it puts immense pressure on shorts. Another critical piece of data to watch is the fail to deliver, or FTD report. Spikes in FTDs, which have been noted in BYND in the past, are a red flag for many retail investors. What's your take on the current short interest? Is it smart institutional capital correctly identifying a failing company, or is it an over-leveraged manipulative bet given the recent volatility? Amidst all this trading drama, it's easy to forget what Beyond Meat actually does. Their business model is twofold: sell their plant-based burgers, sausages, and chicken substitutes in grocery stores, and sell them through food service partnerships with restaurants. The problem, as the recent earnings have shown, is that both channels are failing. In the U.S., retail volumes dropped 13% and food service volumes plummeted 27%. The company is also in legal trouble, with law firms like Blanchard Fonte and Alt announcing investigations into whether Beyond Meat misled investors about the value of its assets before taking the massive $77 million impairment charge. So what happens next? This is where the expectation versus reality framework is most critical. The expectation of the squeeze-focused retail investor is that the high borrow rate and massive short interest will eventually force a catastrophic buy-in, sending the stock back to $5 or $7. The expectation of the short seller is that the company will continue to burn cash, miss earnings, and will eventually either file for bankruptcy or be forced into another dilutive capital raise just to keep the lights on, sending the stock to zero. Analysts at Mizuho noted the company burned $42 million in cash in Q3 alone, and while the debt exchange helped the balance sheet, the company is still operating with a significant $1.31 billion debt burden. The reality is that this stock is now a technical trading vehicle completely detached from its underlying business. The key catalyst to watch is not a new product, it's the cash burn rate. How many quarters does Beyond Meat have before they must raise capital again? A new stock offering would be devastating, as it would dilute the few remaining shareholders and provide a fresh supply of shares for shorts to borrow, crushing the price. The only technical bull case, as slim as it is, relies on the 26% borrow rate. If the company can just survive, just tread water for long enough, that fee will eventually force many shorts to close their positions. This could create a sustained, slow grind upwards, even if the fundamentals are terrible. This is the tightrope this stock is walking. Before we continue, I want to hear from you. Comment below with one simple answer. Do you believe Beyond Meat will be a profitable company by 2027, or will it be bankrupt? Let me know your thesis. In conclusion, the 6.93 rally to 1.08 to close the week is deceptive. It was not a signal of recovery. It was a symptom of a highly volatile and speculative stock.